People are still buying homes. Whether interest rates are 2% or 10%, we all need to live somewhere.
Buying a house isn't difficult. When you want to get into a home, having enough money set aside and save is not the biggest issue because there are closing cost assistance programs. The higher the credit scores, the more options you're going to have. The better interest rates you're going to have. And the more potential closing cost assistance programs is going to be available typically to get into a house. Even if you're getting this down payment assistance or some of them are grants, to qualify for a home, there's three things that every lender's going to look at.
Welcome to our series of videos to educate first-time home buyers. My name is Abraham Reyes Pardo. Deep dive into the home buying process from the realtor lender perspective, and of course holding the hand of housing counseling organization like the Urban League of Philadelphia. Patrick, welcome to the Urban League podcast. We want to talk about today about the home buying process from the lender's perspective. Buying a home can be a scary process for a lot of people. We get a lot of questions from people that get their information from the barbershop, from the beauty salon. A lot of misinformation out there about what the ins and outs of buying a home are. So we thought that it would be a good idea to come directly to the source, to the person who is in charge of the money as well, to give us an understanding of what is going to take for someone to go into the home buying process. Also recognizing that one of the first steps that someone will have to go through with is getting pre-approved for a mortgage. And notice that I'm saying pre-approved, not pre-qualified. I know that throughout our conversation today, there will be a little bit of a special salts from Quain Oak Bank, the organization that you are with right now. But Pat Lopez has 20 plus years of experience in the lending industry. I know you've seen it a little bit of old. We recently completed a very successful pilot program with Pennsylvania Housing Finance Agency. So I thought it would be a good idea for someone like you who has all the experience, all the credentials, to bring our clients into the world of lending 101 specifically for a lot of the first-time home buyers that are out there trying to crack the code in terms of home ownership.
Great. First of all, Abraham, thanks for having me. And I'm really excited to be on this educational series. And I think it's a super smart idea to really, education is the key. The more people know, the more knowledge, the easier things are. Because ultimately, buying a house isn't difficult. You just need the knowledge and the information on how to qualify and what steps you have to do for that, without question. When I tell people to qualify for a home, just think of a bar stool with three legs, okay? And on that bar stool, there's three things that every lender's going to look at. It doesn't have to be Quain Oak Mortgage. It could be Wells Fargo. It could be anybody. Fulton Bank, doesn't matter who it is. What every lender's going to look at, we're going to be looking at income versus your asset versus your debt, income versus your debt, and that's called debt to income ratio. We're going to be looking at credit scores and money in the bank for down payment and closing costs. So those are the three stools. Now, where people come in that's a little bit different is everybody's income is a little bit different. Where somebody may be self-employed, somebody else may be retired and getting pension or Social Security, some salary, W-2, commission. But ultimately, we have to narrow down and look at what their income is, and we want to achieve what their gross monthly income is because their bills come monthly. So we look at gross monthly, not net, gross monthly income. So that's ultimately what we do. Looking at credit, super easy. It takes 5 minutes. We pull a credit report. And then, of course, with money in the bank, we're looking at your bank statements, if you're getting gift money, and of course, if you're getting any kind of down payment assistance, right? Grants.
We'll talk more about that.
Exactly. There's a lot of ways to help people get in the home. But primarily, this three-legged stool, those are the areas. That's what we're looking at, and we can jump in a little bit more in depth with that, but that's what we're looking for.
In terms of employment, I heard something. I heard that people must be employed for a certain number of months, years, continuously in order to be eligible for a mortgage. Then we're hearing some different things from different lenders. What would you say is a general rule in terms of consistency of employment for someone to get a mortgage?
So every lender is going to be looking at a 2-year history. Okay, we're going to look back 2 years to see that history. But you don't have to be employed for 2 years. So if I just graduated college, and say I'm a nursing student, I graduate from college for nursing, and I start my job in nursing, the college counted as work, my education. So that counts as part of my 2 years. So I don't have to be at that job. Or if I'm at a job and let's say another company offers me more money, so I leave this company to go to the new company that's offering more money, you don't have to be at the same job. You're still working and I'm taking a better opportunity. Nobody's going to penalize you for that. So all in all, you don't have to be a continuous at one job for the 2 years. That does not happen. Education counts, and then also switching from one job to another. The only time where there is an issue is if is there a gap. Hey,
Yes.
I'm at one job, then I stop working for over 6 months, and then I start another job. If it's over 6 months, I have to be back on that new job for 6 months if I have a big gap. But if there's not a gap, then we can piece it together.
During the pandemic, we heard a little bit about that. You also mentioned self-employment or contractors. We have a lot of people who are 1099 there or self-employed. Is there? I know that you guys are going to be obtaining transcripts, copies of their transcripts. We, for the counseling process, typically obtain copies of their tax return. How many? How much? Can you give us a general idea of? Are you still looking at 2 years? What do you need for someone who is a contractor or self-employed?
So once again, typically we're looking at a 2-year history. Depending on what kind of loan you're doing, FHA is 2 years, conventional at least 1 year. So it depends. There's variations on what kind of program you're doing. But once again, we all circle back to the 2 years. Ultimately, that's what we're looking at. And we're looking at that history. Now, if you turn around and let's say I'm an Uber driver, because we have a lot of Uber drivers. I'm an Uber driver, and in 23 I claimed $30,000, and in 24 I claimed $50,000. We have to average those two together. So that's altogether 80,000. So we can only give credit for 40,000 of it. So 40,000 a year, once again, divided by 12.
You see me smiling,
Right.
so I'm going to look at the camera and I'm going to say something. Your accountants can be too smart for your own good. It is okay that they are going to help you save some money, but in the context of buying a house, they might be hurting you if being too good by putting money, finding ways to save you money.
Write-offs.
Yeah, these guys are going to be looking at, typically you look at Schedule C of the tax returns.
Right, the profit and loss, yes.
The profit and loss, and then if that profit and loss looks more like a loss, then that's going to be a problem.
Absolutely.
It's going to look like they have basically no money. I can tell you how many of our self-employed or contractors have had to amend their tax return once they figure out what this process consists of. All right, so we have our income. We have touched on people who are W-2. We want 2 years employment history. Self-employed, we want, if they're FHA, we want 2 years tax returns, 1 year if they're conventional. If they are, what about if they have someone who has a pension, disability, retired, VA? What do you need in those cases?
They generally will have an awards letter. So if your Social Security is awards letter, every year it comes out, and just recently, because inflation was a little bit higher, they got the awards letter say, hey, congratulations, we're giving you a 4% increase. So that awards letter is going to help there. And it's not just for them, because you could have a child who's receiving Social Security disability, and it's made out to the mother or the father's name in care of.
Yeah.
So we can use that as income if it's in care of. So that's part of the income as well.
Yes.
And then, of course, if you have pension, you have your tax forms that are sent. I think they're 1099Bs, but I don't even know what the thing is. But you get that every year as well. And then we're going to see it on your tax returns, because you're going to show it on your tax returns. You may not have to pay tax on it, but you'll show it. Now, there are times if all you're getting is Social Security and you're under a certain threshold, that you won't have you don't have to file taxes. And
Right.
in that case, it's just a letter to whom may concern. My accountant said I'm under the threshold, but we have the awards letter. That's why I don't have my tax returns. You know,
Correct.
that kind of thing.
Correct.
So you don't have to if you're under a certain amount. But once again, everything's documented. Ultimately, you have to file tax returns to the IRS, once again, unless you're under an income threshold where you don't have to.
And you see my little wheels already spinning that I'm thinking about something because what we do to calculate income for someone who is Social Security disability is we gross it up.
Right.
You guys do the same?
Correct. On conventional, we're able to gross it at 125%. On FHA, is 115%. So yes, unless they're paying tax on it. So you have to look at their tax returns, and on their tax returns, there's a part where you put the Social Security and then the taxable amount. So if there's nothing in the taxable amount, then we can gross it up. If you're getting Social Security, but you're also have other incomes and you're over a certain threshold, you're gonna have to pay tax on it. So it depends for all individuals, if you can gross it up and if you can't.
Do you do the same with pensions?
Pensions, 99% of the time, are taxable.
Are already
Yeah,
taxable?
it's Social Security is generally the
Yes.
one.
Okay, let's shift gears a little bit. So we talked about the coins, the meat of the transaction, which is whether or not someone has the ability to repay the money. But we know, and the audience knows, and you know, that one of the first questions that we're gonna get, one of the first things that we're gonna talk about is credit.
Right.
No credit can be good credit. Bad credit is bad credit.
Right.
What is the minimum FICO score someone will need to get approved or pre-approved for a mortgage? Whether that's through, because I understand that you guys may have your own overlays,
Right.
your own concerns in terms of FICO score, but what is the minimum FICO score someone will need to be able to get a mortgage through you guys?
Okay. Generally, we say a 620 credit score, but FHA, you can go down further to a 580. Typically, what ends up happening, we run it through what's called DU, desktop underwriting, okay? And that's ultimately going to tell us if it will work. So I've had people that had a 610 credit score, run it through DU, desktop underwriting, and we get what's called an approved eligible. Every company in America, there's one DU, you run it through the same system, and we'll do that. So it's not set in stone what a credit score has to be, but typically we tell people 620, because once you're 620 and above, it just opens up the doors for more options of doing other kinds of things, like potentially getting closing cost assistance money, down payment assistance.
Yes.
Because when you have a lower credit score and then you layer getting that down payment assistance money, then you may not get an approved eligible, because the less money that an individual has of their own, or just the overall dynamic of that individual, that DU, desktop underwriting, looks at everything. So if I have $30,000, $40,000 saving in a bank, DU's going to look at it saying, hey, this person has the ability to save. It's their own money. Versus if I have no money in the bank,
you're touching. This is a teachable moment, again, because we get a lot of families, a lot of individuals coming through the process thinking that credit is the key.
It is the key, though.
It is a key, but you just talked about compensating factors.
Correct. Yeah.
You talked about someone whose credit is, but they have the ability to save.
Right. Debt to income ratio is low.
Or they have a low debt to income ratio.
Right.
Again, bad credit is bad credit. Right. No credit might be good credit. Good credit is good credit. 580, you took us down to the 580, understanding that 580 comes with probably a higher interest rate. Mm-hmm. You took us up to 620, which is, in my experience, more consistent from what I'm hearing from different lenders and different actors. So I always tell people, if you're gonna focus on a 580, you have an emergency. You have to move out of that house tomorrow, and therefore you're gonna take whatever you can get if you're able to get it. And there are 580s and 580s. There's a 580 that is you're paying things inconsistently, and there's a 580 that comes with a lot of debt, and then that's gonna mess up things. Right. So there are 580s and 580s. 620. So tell us a little bit about what goes into putting that FICO score together.
Yes. Okay, so the way the FICO score comes about, first of all, FICO is Fair Isaac corporation. They've been around for 30 years. So the mortgage industry has been using FICO score since 1995. And when you run something through DU, once again, desktop underwriting, it draws in the credit information and then DU reads that, okay? So that's how that dynamic works. Now, where does the FICO score come from? What FICO's trying to do is see or try to predict who's going to be 90 days late on a payment. Now, how do they do that? It's real simple. They look at 2 million people today, and they take those exact 2 million people, and they go 2 years back in time, those same people, and they look at what was going on 2 years ago that caused them to have those 90-day lates, or lates period, okay? And what they found was 35% of your score, or 35 points out of 100. The second part was they looked at credit utilization. So if I have a credit card and I have a $500 credit limit and I owed $500 on that credit card, that's bad utilization. I'm maxed out. So that represented 30% of my score, or 30 points. Then they look at credit history. How long have I had history? If I turned around and I have 6 months worth of history, there's not enough time for me to mess up, perhaps, right? Versus somebody who has 15 years worth of history, I've never missed a payment. That's 15%. Then you have your credit mix, and that would be a mortgage, a car, a couple credit cards. That's a good mix. That's 10% or 10 points. And then there's inquiries, which is 10% or 10 points. Okay, so that makes up 100. So what we're trying to do is score 100 on that test, right? So first thing, pay everything on time. Yeah. But I always thought if I paid everything on time, my credit would be real good. That's only 35 points out of 100. If I did everything else wrong, I'm only getting 35 out of 100. What we advise everybody is, hey, if you're getting ready to buy a car, buy a house, pay down your credit cards. Have the knowledge, if I pay those credit cards, remember, they're trying to predict who's going to be late. If I have a zero balance on a credit card, I can't be late. Yeah. I can't be late. I'm going to get a statement sent to me, hey, you owe nothing, don't send anything in. I'm not going to send anything in. They're going to tell the credit bureaus, paid as agreed. But if I'm maxed out on all my credit cards, and God forbid I lose my job, I twist my ankle, I can't go in, I may not be able to make those payments, right? So that's part of it, and then the course history and everything else. So number one, pay everything on time, and keep your credit utilization down on your credit cards. And that's only for credit cards, not installment loans. Installment loan would be like a car payment or a mortgage. That's an installment loan that has an expiration time. Those two items, pay everything on time and keep your credit cards as low as possible, that is the key. That's what you want to do. If you do those two things, most likely your credit scores are going to be pretty darn good. And once again, we already talked about the higher the credit scores, the more options you're going to have. The better credit, the better interest rates you're going to have, and the more potential closing cost assistance programs is going to be available, because some of them do have credit scores attached to them.
Yes, yes, and not to share that this is a practice of Queen Oak, but there are some banks that may look at alternative means of credit if someone doesn't have a credit history. Correct.
You can do that. That's possible for certain outlets, 100%. It's alternative credit. And that would be, hey, give me your payment history on your cable bill, your car bill, your rent, those kind of things, as opposed to having any credit history at all. So there are some outlets for that. But once again, when you're going down that rabbit hole, you're just limiting yourself. The less options, that you have, okay? What Henry Ford turned around and said you could have any color Model T you want as long as it's black, because they only did black cars back then. So it just limits the options that you have. So
again, it's a tool that can be tapped into by people who, and we have, oftentimes we get folks who are in a different timeline and they need to close sooner or they need to get a mortgage sooner. If they're lucky enough, they may have no credit at all, because then they can use alternative means of credit. Again, I'm going to say it one more time. Bad credit is bad credit.
Right.
That does not trump. There's no way to spin that around. Good credit is good credit, and no credit might be good credit. So I have my money, I have my credit history, I have...
Let me just jump into one thing that you mentioned.
Yeah.
There is right now the Fannie Mae Freddie Mac, the cabinet member who's running that, mentioned that they are looking into the Vantage score, okay? So that Vantage score, that was a bill that was passed by the Trump administration in 2018, okay? So since 2018, they've been running scenarios, running things through to see the viability, if the integrity of that score, if it's good, okay? So now Bill Pullett, who's runs Fannie Mae, Freddie Mac, which are the agencies that do most of the loans, other than
The
FHA.
leaders, two organizations you won't hear about, but the two organizations that define how a lot of what this process looks like.
Exactly. So they're talking about that they are going to start accepting a Vantage score. Now, with that Vantage score, the advantages to that, it comes into some of that alternative credit that you are mentioning, that they will look into the rental history. And in turn, your credit scores could be a little bit higher. And these are for thin profiles, people that don't have a lot of history. So if you have two people, somebody who has credit history for 15 years, a bunch of different trade lines just mean I have credit cards, car payments, that kind of thing throughout the years, versus somebody who has very limited, the advantage may be on that Vantage score, is what they're saying. We don't know for certain because we haven't seen it in practice. But if two people have a ton of history, the Vantage score and the FICO score will pretty much be the same. So the advantage is what they're saying is with that Vantage score, it may help the thin and potential underserved market, okay? Now the million-dollar question that we have is, how is the landlord information going to hit TransUnion, Experian, and Equifax? So understand, TransUnion, Experian, and Equifax, think of them as giant warehouses storing your information. Okay, they're not giving you a credit score, they're storing your information. And then they funnel that information to the Vantage score 4.0 or to FICO. And then FICO, with their algorithms, spits out the scores for it, okay? So my question is, and this is where in the next month or 2 months, and I'm thinking probably January of 2026, February, the first quarter of next year, we'll start utilizing that Vantage score to help people, and it's going to give us an alternative. Say, if we run a FICO and it doesn't work, I can run the Vantage, that may work. So now I have a choice of running the two. But my question is, how is the Vantage score going to get that rental history? Because a landlord isn't submitting their information to TransUnion, Experian, and Equifax. They're not reporting it to it.
They have to report.
They have to report. And then same thing with utilities, whatever. So it'll be interesting whether, are you going to now do the Experian Boost where you're reporting? So there's a lot of chatter and a lot of talk going back and forth in between this, but it hasn't been laid out 100%. But come next year,
it's a possibility. It's in the horizon.
And next year, 2026,
I like that.
2026. And the nice thing is, if I have two options, it's better than, because if you don't qualify with a FICO score, at least I have another shot, another bite at the apple.
Yeah.
And more people may qualify.
Yeah, I like that. We have a number of folks, some of whom might be watching this video, that come in here knowing what their Vantage score is, because Credit Karma is accessible. It's an Intuit product, so they spend a significant amount of money on publicity and whatnot. You see the commercials all the time, right? I think at some point I saw someone coming through with a Credit Karma loan or some other product. So just know, it's important to know that this is not a static industry. Things keep changing. So what we're talking about, it has been true for a long time.
30 years. FICO had a monopoly for 30 years of doing it one way.
It will probably be through moving forward with some caveats as well. So we have our monies, we have our employment history, we have our credit, and we almost forgot to mention the three agencies that are scoring people all the time: TransUnion, Equifax, Experian. For our processes, we want to know what those three agencies think about you, think about your financial profile. So we have credit, we have monies, we have our savings. You want folks to have some money saved, regardless of whether or not they are using one of the down payment assistance programs that we'll talk about. But we often get the question of how much. Is there a number in terms of savings? The sky is the limit. Save as much as you can, save as much as you want.
Save as much as you can is always a positive thing, to have money versus not having money. But typically, to get into a house, even if you're getting this down payment assistance, or some of them are grants, even if you're getting money, a good rule of thumb is you're always going to need at least $5,000. And the reason why I say that, you may not need the $5,000, but when your agent does agreement of sale, they're going to ask for a deposit. And when you put a deposit, you can't say, okay, I'm going to put a deposit of $500, because the seller and the seller's agent, they're going to say, I'm not taking the house off the market for $500. The reason why you put a deposit is skin in the game, because if you don't put a deposit, or the deposit's super low, if somebody just gets cold feet and say, you know what, I'm out, I don't want to, I want to buy this house, you're only risking $500. But if you have $5,000 just for a whim of saying, I don't want to buy, you're not going to risk your $5,000. Seller agents, they know that, so they want a deposit. Now, understand, if you get turned down for a loan, or if the house doesn't appraise, or if there's title issues, no, you get your money back. So what we're talking about is, hey, it's a week before closing, and I get cold feet, and I decide to back out. Those are the people that could lose their deposit money. So it's in the best interest of the seller to get a larger deposit, okay? Now, because you have to look at things at both sides. Hey, as a buyer, I want to give as little as possible, but as a seller, I want to get as much as possible. There's two sides of this. So typically, you're going to need $2,000, maybe $3,000 on deposit. Then you're going to do a home inspection.
That has paid out of pocket.
Out of pocket. So that's another $600-700.
The appraisal.
The appraisal, another $500-600. So when you start adding all that up, hey, you're somewhere around $3,000-4,000-5,000.
Yeah.
Now, understand, certain programs, if you get enough money, when you go to settlement, you'll get a check back. Okay? But you still needed that $5,000 to get to the settlement, to get that money back.
Things going. Yeah, important to is that the down payment closing cost assistance program worked until the end.
Right.
So the funds are issued to the title company, to the closing agency, and they are the ones in charge of applying the funds. Obviously, a lender will have some knowledge of whether or not the money's you hope that the money's coming through, right? But the funds, again, won't be applied until the end. So therefore, people need to have a little bit of their own reserves to be used. How often do you use a type of product that requires people to show that they have a couple of months ready to go?
So that varies. There's some programs, down payment assistance programs, require that you have 2 months of reserves after closing. So if my payment's $1,500 a month, I have to show that there's at least $3,000 left in their account. Now, their 401k, as long as you're able to access your 401k, counts as reserves. So you don't have to necessarily have it in your savings account, and you don't have to liquidate that money. So your 401k money can act as monies in reserves. And also, when we're running something through that desktop underwriting, to get an approval, it may ask, just to get the approval, that there's 3 months of reserves. And typically, we then turn around and use that 401k money to show the person has the $4,500 to $5,000 in their 401k, and we act as reserves just to qualify them for the loan. Forget about closing costs or anything else. So there's a lot of layers to that, but yes, a lot of times the loan will ask for reserves. The down payment assistance program will ask for reserves. Sometimes they don't. So it just depends.
We want people to have reserves because you're coming from being a renter to being a homeowner. Life is going to happen. Something is going to break.
Right.
And then either you're a good, very good handyman or fixing, or handywoman fixing, or you're going to be paying someone to fix things. And I don't mean to scare anyone, but anything plumbing and electrical related is expensive. So we're starting to get into the price, the conversation about the collateral. And I want to bring up a couple of things that you said earlier in our conversation. One of them being the situation with the appraisal and the inspection. Part of leading to the end of this path is I already got pre-approved. We're going to be talking, the realtor is going to help me negotiate the purchase of a home. I am getting there. There are two actors in there. One of them is the inspector. The other one is the appraiser. You said if the appraisal doesn't pass or the appraisal comes low, that might be problematic.
Right.
If in my world, I'm going to say if the house is inspected and then you're not satisfied with the inspection, if there are things that need to be fixed and the seller does not want to fix them, then you may or may not be willing to go through with that transaction. Some people negotiate a lower price or whatnot. In your world, if the appraisal, if the collateral is not there, what's going to happen?
Okay, so we get an appraisal. Let's say a house is 200,000, the appraisal comes in 190. We turn around and we tell the buyer's agent and the buyer, and we tell them, say, hey, the appraisal came in 190,000. Here's a copy of the appraisal. Now the realtor is going to go to the seller's realtor, and they're going to turn around and say, listen, we like the house, we still want to buy the house, but the house came in at 190,000. We'd be more than happy to pay 190 for it. I'm going to send over an addendum lowering the sale price. That could be one option.
If the seller agrees.
If the seller agrees.
If the seller agrees.
Right. The second option would be you turn around, you as the buyer's agent tells the seller agent, hey, the appraisal came in at 190, not 200,000. Will you reduce the price? And the seller could turn around and say, I'm not reducing anything. I want my 200,000, period.
Yeah.
So now it comes back to the buyer. Does the buyer want to pay that $10,000 gap? Because we're going to do the loan at 190, not at 200. So they would have to come out of pocket an additional 10,000. So then that would be up to the buyer if they're willing to come out of pocket with that $10,000. Generally, what ends up happening is the seller will reduce the price, or they'll split in the middle, where they'll say, okay, we'll sell it for $195,000. You come out of pocket for the additional $5,000. We'll lower $5,000, something like that. Somewhere, or the deal is dead. It gets terminated because you can't agree. You're just going back into negotiation, and you're going to see what works. And ultimately, it depends on where you're buying and how much inventory there is. Out in the counties, there's not a lot of inventory, so a lot of people will turn around and say, okay, we'll pay the difference. There's no houses for sale.
No.
Okay. In the city, there's more options. So you may turn around and say, listen, if you don't sell for 190, there's 5 other houses on the block that I can buy. So it just depends. Law of supply and demand is always the controlling interest when it comes to that's what's going to ultimately win out.
You just touched on something very important, and I need to look again to the camera directly and say, people are still buying homes. Whether interest rates are 2% or 10%, people are still buying homes because we all need to live somewhere. And for so many of our clients, for so many people, I mean, we had a good number of people that were able to take advantage of the historically low interest rates. But for so many of our clients, as long as the payment makes sense, they're going to move forward with the process. You just mentioned this is an urban environment, Philadelphia, that we're talking about. If you go out to the suburbs, the conversation might be different. Here in the city, there is demand for housing, and then housing of a certain price is becoming a little bit more scarce. Collateral. So you guys, everything goes through. I'm a happy homeowner. I moved into my house. We talked about Fannie Mae, Freddie Mac. They may get a letter saying, your loan is now owned by Fannie Mae, Freddie Mac because they originate the loan. You guys won't get to deal with the investor. That's not customary for this industry. But what lenders will do is the loans get sold in the secondary market so they can continue giving out loans, right? So Pat and other lenders, from the moment they're making out the loan, they might have in mind already who is that loan going to be backed by who. So FHA, VA, Freddie Mac, or Fannie Mae conventional loans.
Right.
Also, by the way, those are government loans and conventional loans. The other government loan that we didn't mention is USDA out of the rural areas, 100% financing for those who can use USDA loans. VA is 100% financing as well. You still have to deal with closing costs, right? So you already approved me for an FHA, conventional, VA, USDA, whatever product I qualify for. I moved into my house. The loan might be getting sold on the secondary market. You are now moving up, giving out other loans. I have experience with foreclosure, not to scare anyone watching this video. But what happens if I'm unable to make my mortgage payment? Am I going to get a call from Pat Lopez and say, hey, you haven't paid your mortgage. Can you please pay it? That's, to my understanding, that's not how that process works.
No. So what ends up happening is the servicer. So once we're done with the loan, it's going to go to a servicer, and it depends on what kind of loan you're doing. If you're doing a state bond program, it's going to PHFA. So it just depends where it goes. So the servicer is going to call and say, hey, what's going on? Ultimately, the goal is to keep you in the house and to work out some kind of arrangement.
Yes.
You know, what's happening? Foreclosures are pretty low, and delinquencies, major delinquencies, are pretty low because nowadays, everybody who's qualifying for a loan qualifies because we have their pay stubs, we have their W-2s, we have their tax returns.
Yeah.
Back in 2005, 2006, there were things called liar loans where there was no income, no asset,
Yeah.
no job.
Yeah.
So you could say, I make $42 million a week. So those programs are no longer there. So historically, what ends up happening is if somebody can't make a payment, it's because they lost their job and a major illness so that they can't work. A husband, wife, boyfriend, girlfriend, and the other person leaves and just goes crazy, or one passes away, or major illness, but you're relying on the two incomes. So with that, the foreclosure rates are still historically low.
Very low, very low.
And lenders want to do everything they can to keep the person in the house and to work out arrangements, even potentially lowering the payment and putting whatever money that's owed in the rear of the loan. Hey, when you get back on your feet, there may be $10,000, $20,000
balloon payment.
at the end or what have you. So that kind of stuff is rare, but hey, life happens. It is what it is. Lenders are trying to do everything they can to keep people in the houses.
I always like to tell people, and we're nearing the end of this conversation, I always like to tell people that life is going to happen, as you will very well just mentioned. There are situations beyond your control. We can't predict what's going to happen tomorrow. We won't know what's going to happen in 30 years, but statistically, first-time home buyers will be moving out of that house in 5 to 7 years.
Right.
They may think that they're in love and that's a forever home, but statistically, most first-time home buyers will move out of a house in 5 to 7 years. The house, let's not lose sight of what the house, the actual building is. The house is collateral for the money that you're borrowing from a financial institution. Pat's role, loan processor, underwriter as well, because we're here talking to Pat, but Pat is going to work with a loan processor, and their job is to make your profile look very appealing for the underwriter. You won't have access to the underwriter. The underwriter is behind closed doors looking at the data. So by the time the file made it to the underwriter, that means that Pat and his team have worked your magic. And I say that to say you have worked your magic, because there's some loan officers that unfortunately can't close loans because they don't want to work their magic, but that's a different conversation, right? So that gets to the underwriter. The underwriter will check or deny that loan, and then you have a situation where, if approved, the house becomes collateral for the loan, right? Very important, the concept that I always want people to make sure that they grasp and understand. Similar to defaulting on the mortgage. You guys, or the investor, the servicer, will want to make sure that property taxes and homeowners insurance are paid on time. Most of these transactions will have an escrow account.
Correct.
Can you give us a little tease of what an escrow account is?
Absolutely. Okay, I'll jump into that, but let me just state one thing. When you get a loan, you're getting a 30-year fixed loan, 99% of the time.
Yes.
Okay, so by having a 30-year fixed loan, your payment pretty much stays the same. It may go up just a little bit because maybe real estate taxes go up or your homeowner's insurance goes up, but your principal and interest, your loan part, that's fixed, okay? So your payment may go up 1%, 0.5%, something like that throughout the years. It'll go up slightly because the taxes and insurance, like we just mentioned. Now understand, incomes typically will go up 2 to 3%. So that's why people can always afford a house, because their incomes generally go up faster than what the mortgage payment is, because the biggest component of your mortgage payment is your principal and interest, and that's fixed for 30 years.
Yeah.
That's not changing, okay? So that's why the 30-year fixed loan is so stable, and that's why there's so few foreclosures. Now, it's different in other countries. In Canada, you have a 5-year adjustables. So you have to refinance your loan every 5 years. In England, the same kind of thing. So the rest of the world are jealous at the stability of our housing market because of our 30-year fixed loan.
That was a lesson learned. That was a lesson learned in 2007 and after that.
So that's what you have there. Now, when you make your payment, like you mentioned, there's going to be, money's going to go into two places. One, your principal and interest payment is going to go pay the loan. The other money, let's say it's $300 of your payment, is going to go into an escrow account, or what I like to say is your savings account that the bank has set up for you. So every month when you make your payment, hypothetically, let's say your payment's $1,700 or $2,000, $1,700 goes to pay the loan, $300 goes into your escrow account, aka your savings account that the bank has set up for you. Okay? So every month, $1,700 pay the loan, $300 goes into that escrow account. And when your taxes are due, the bank will turn around, call the city of Philadelphia up, say, hey, I'm getting ready to pay the taxes. What are they? Boom, they're this much, and they're going to send it out of your savings account. And the same thing for your homeowner's insurance. Hey, once a year, the homeowner's insurance is due. Hey, how much is the homeowner's insurance? No changes. Boom, they're going to send that out to Allstate, State Farm, Geico, Progressive, whoever you have. So every year, it's going to go out of your savings account, and you're putting 1/12, and that's your $2,000 payment. The bank separates the money, puts some money in your savings account, some money goes to pay the loan.
They chop, I always like to say, they chop the payment in 4 pieces. In some cases, they do 5 because of private mortgage insurance, if there is any, or PMI.
Right.
And you guys have to factor in, if Philadelphia per se was an HOA place, you will have to factor HOA as part of that. But you don't have to here because luckily we're not an HOA city. But in other places, part of considering this PITI formula is including the HOA. And I feel like we're full circle because that PITI goes back to household income and debt to income ratio, which is where we started. That means that what we refer to initially, what you refer to by debt to income ratio is how much money, what type of payment you can afford based on your income.
And your debt.
And your debt.
Because you're going to subtract
and your other, it's the front end and the back end. Right. If you're applying for some of the loans, for some of the grants, then your debt to income ratio also has to be factored in, front end, back end. And what else is important about debt to income ratio? If your debt to income ratio is too high, then needless to say that you'll have to rework some stuff credit-wise or income-wise to be able to qualify for those.
Well, you pay debt down or you buy less of a house to have your principal and interest payment a little bit lower and all that. Now, what I talked about in the very beginning is having a stool with 3 legs. We talked about income, debt to income ratio. We talked about credit. What we didn't talk about is savings, some of that dynamic of savings. Do you want to jump into that?
We did touch briefly.
We didn't really get into it too much. There's stuff where, let me give you some taboos or stuff. Okay, first of all, we did talk about 401k. That can be money used as reserves, and you can use that because you can typically take out a loan or to buy a house. Typically, not all 401ks will allow this, but most of them will allow you to take money out.
Not take the money out. Some employers allow people to borrow money against their 401k.
Both. You could do both.
You can do both.
You could do both. You could take a loan out, and that's what I suggest most. Take the loan out because all you're doing is paying yourself back. Or you could take a hardship, and one of the hardships are if you lose your job, if you're buying a house, to just take the money out, period. And you're going to have to pay tax on that. That's why we say do the loan
Please
first.
do the loan. Please do the loan.
Gifts. You can get gifts from family members, 100%. When you get a gift from family members, make sure that they're given to you out of their bank account because we need to see the money leaving their account, going into yours, and they sign a boilerplate gift letter. It's just a fill in the blank. Take 2 minutes to fill it out. You don't have to write a whole letter. It's filled out for you, and you just put names in there. So you can get gift monies, 100%. Anytime you're buying a house, in that two-month span, we're looking at 2 months worth of bank statements. So any kind of large deposits, we're going to question it. Where did this money come from? And if it was cash that you had under the mattress, no good. We can't verify where that money came from. It's problematic. You're better off if you have money sitting under the mattress, give it to your mother, your father, your brother or sister, give it to them, and have them give you a gift. We don't need to source where their money comes from. I don't need to see 2 months of bank statements of theirs. All I need to do is see the money leaving their account. So I don't need.
But you guys want certainty of where the money is coming from.
Correct. So we're going to get a bank statement with a one-day transaction showing that Joe Smith withdrew $5,000 to give to Tom Smith who is the son or whatever. Okay?
Yeah.
So we're going to see that and they'll fill out the gift letter as far as that's concerned. Another big issue nowadays is you have the Zelle payments and the Venmo stuff. People are moving money like they're playing a game or something. Like 10, 20 of them in a month. Crazy. Yeah. That drives underwriters crazy, and it drives me crazy because we have to explain, why is all this money moving back and forth? What is going on? So if you're buying a house, minimize the Venmo payments that you're doing. Now, if you're Venmoing your landlord, typically you'll say Venmo rent. And then, okay, it's once a month,
so they
you
know.
get paid. But what I'm talking about, it's become a sport with this Venmo, Zelles going back and forth. It's crazy.
Yeah,
it's
Cash
crazy.
App. Cash App is the other one.
It's crazy. And then we have to get those bank statements to see what's going on there, because some of the programs, the down payment assistance programs, requires that you can't have more than $25,000 left in your bank account, $50,000 left in your bank account afterwards. So we have to get every bank statement that you possibly have or where money comes from. So it's a nightmare when it comes to that. Be smart. Stop doing all that, especially if you're going to buy a house. Stop.
Certainty is about buying a home is about what you know, taking a snapshot.
Right.
Of what you know as a lender, taking a snapshot at a certain time and moment. There is a chance, though, that once someone starts the process, if you go beyond 90 days, and everyone, let's say someone did everything they had to do to get to that point where they get pre-approved, and then all of a sudden they start getting problematic with their spending and credit card usage and whatnot. People need to know that after 90 days or 60 days, you guys can pull credit again, or
Correct.
Will pull credit again if the process hasn't been completed.
Right, yes. So what ends up happening, credit is good for 120 days, so 4 months. But we have to settle in that time frame. So if I pull credit today, I have 4 months until you have to go to settlement. Done. So a lot of people, it may take them because they're super picky or they just can't find anything that's suiting their needs, whatever the case may be. And now, they're 3.5 months in. You're not going to close a loan in 2 weeks, so then we would have to re-pull credit as far as that. So yes, but what also ends up happening is there's something called a credit refresh. And what we do is 10 days to a week before closing, we have to relook at credit, but it's not a full-blown credit pull. So we're not pulling credit scores. All we're doing is making sure what this credit refresh does is make sure that there was no late payments or there was no new credit opened. And every lender has to do that, because if you're buying a house and you have a garage, now you went out and had 5 credit pulls from Lamborghini to put a Lamborghini in the car, then we're going to say, hey, did you get a car loan? Or appliance stores and all that kind of stuff. So you don't do anything with your credit. You don't get any new, because in that 7 to 10 day window, we have to do that credit refresh.
Yeah.
And now if something happened on that credit, then we pull a credit to see what the scores are, especially if there was a missed or if there was new inquiries because you got a car or what have you. So that is happening on every loan in America. Basically, that's 7 days out.
So be good to get to the point where you can get pre-approved, but then you want to stay good. And there's also another prize, another reason why people want to do that, and that is because down the road, you want to be able to refinance your loan. Interest rates are not the highest they've been historically, but they're a little bit higher than what they were 3 or 4 years ago. So if an opportunity comes your way, you might want to refinance. We saw a lot of people running into that wall because they didn't have the credentials, and when the interest rates dropped during the pandemic, they were not able to refinance, unfortunately. Pat, I want to thank you for...
Can I say one more thing? One more thing. Typically, when you want to get into a home, having enough money set aside and saved is not the biggest issue, because there are closing cost assistance programs, which you'll get into later, down payment assistance. Some of them are true grants or a combination, because you can stack some of that stuff together.
Yes.
And just to give you an idea, last year we did 170 and change loans that had either grants or down payment assistance for over $5.7 million of the down payment assistance or grant money. That was just the grant money or down payment assistance. $5.7 million
Nice.
of monies to help people get into a home. So it is super, super possible to get into a house for less than what you think, because most people think, I need 20% to come get into a house. No, what we talked about earlier, $5,000.
Yeah.
Typically will allow you to get into a home. So that barrier of saying, oh, I have to save a ton of money isn't always necessary.
You're saying it like if it is nothing, but 4.9 million.
5.7 million, don't shortchange me.
5.7 million in down payment assistance it's a lot of money. It's a lot of money. Pat, along with a group of committed realtors and lenders, are very excited about these programs. You guys know, every time we share something with you, you want to know the ins and outs of it so your clients can benefit from it. Sometimes we stack the programs. That's been terrific. Just know, for the audience, just know that's not the rule across the board.
Right.
Some lenders and realtors are not as excited, are not as familiar. Therefore, you will hear stories about how money was not applied, or money was not achieved, or money was not received. I do want to thank you now, Pat, for your efforts in educating our community by way of this video, but also by way of the work that you're doing every day. You have a podcast, so if anyone wants to find you, they can find you also on the
YouTube,
podcast. On YouTube,
The Real Estate Show with Pat Lopez. Go
the
to
Real Estate
YouTube.
Show with Pat Lopez.
We have all sorts of people on there, and what we try to do is educate as much as possible people. So thanks for that little plug.
Yes, absolutely. And for everyone, thank you so much for having joined us for this conversation with the great Pat Lopez. Remember that this is a series of videos that we are sharing with you ahead of our first-time homebuyer webinar. Please make sure to check all of them out. Again, my name is Abraham Reyes Pardo, but with Quain Oak. Thank you, everyone. Hope you have a great day.